And I gotta do one more for my Australian peoples. Quick look surprise, another Wolf Street article. Housing bubble pops in Sydney and Melbourne, Australia. I've been doing articles about this, reading them, talking about it for the last couple years. I'd say Australia's been in the spotlight, amongst other ones like us, U.S. and Canada and some other areas. But they've been having some problems lately. I've been seeing more and more articles coming out about the housing issue. Sure enough, here's another one. Housing bubble pops in Sydney and Melbourne, Australia, and with impeccable timing, an immense flood of new construction. In Sydney, breeding ground for one of the world's biggest housing bubbles, prices of single family houses dropped 7.3% in August compared to a year earlier. Prices of units, condos in US lingo, fell 2.2% year over year. Price declines were the sharpest at the high end, with prices down 8.1% in the most expensive quarter of home sales. Prices of all types of homes combined fell 5.6%, according to CoreLogic's daily home value index. The index is down 5.8% from its peak a year ago in September. Melbourne, with the inflection point, has been lagging a few months behind Sydney's, is in the process of catching up, by the way. Over the 3-month period, June to August, prices fell 2%, making Melbourne the weakest housing market among the capital cities. By segment, house prices fell 2.7% from a year ago, while condo prices still inched up 1.5%. At the most expensive quarter of sales, prices fell 5.2% from a year ago. For all types of dwellings combined, prices declined 1.7% year over year, the lowest level since early June 2017, according to CoreLogic. Prices are down 3.6% from their peak at the end of November 2017. CoreLogic tracks the largest 5 of Australia's 8 capital cities in a separate index. Due to the size of their housing markets, Sydney and Melbourne weigh the most. In the remaining 3 of the 5 capital cities in the index, prices were mixed in August. In Brisbane, home prices inched up 0.9% year over year. In Adelaide, home prices ticked up 1%. In Perth, home prices fell 2%, with houses down 1.5% and condos down 4.4%. Prices have been skidding since late 2014 when Western Australia mining boom turned into a mining bust. The aggregate 5 capital cities index fell 3.1% in August year over year. The index has declined month to month for 11 months in a row and is down 3.5% from its peak in October of 2017. With impeccable timing, there is a flood of new condos expected to be completed over the next 2 years, something avid crane counters in Sydney and Melbourne have been swearing for a while. Here are some of these astounding. I just got an update from my guy Rob. Don't worry about the Bitcoin drop. His chart shows something really nice. Okay, I'm gonna have to do another video. May have to go live on this one, or not live, but tonight. So you might see it before you even see this video. So anyways, with impeccable timing, there's a flood of new condos expected to be completed over the next 2 years, something avid crane counters in Sydney and Melbourne have been swearing for a while. Here are some of the astounding numbers that CoreLogic estimates based on data collected from the industry. Greater Sydney. In 2019, there'll be 31,500 new condos are scheduled to be completed. 2020, the year 2020, another 45,500 condos are expected to be completed. This brings the 2-year total of new condos to 77,000 units, which will increase the total stock of condos by 9.3%. Greater Melbourne, the oncoming flood of new condos is expected to reach 29,000 units in 2019 and nearly 50,000 units in 2020. Over the 2 years, this will increase the total stock of condos by nearly 79,000 units, or by 11.5%. As it becomes harder to find buyers for these projects, developers may delay or cancel some of them, so not all of these units may be completed in the 2-year period. In some of the other cities, the stock of condos is expected to increase over the next 2 years in a similar fashion. Brisbane 18%, Greater Adelaide 12.5%, Greater Perth 5.7%, Greater Hobart 3.8%, and Greater Darwin 9.9%. Nationally, 94,500 condos are estimated to be added in 2019 and 2020, which would increase the existing stock by 9.3%. And so CoreLogic explains, over the past 5 years, there has been a significant increase in overall unit supply. At the same time, housing market conditions have deteriorated over the past year, particularly in Sydney and Melbourne, with dwelling values falling and rental growth slowing. In the face of weakening housing market conditions, both of these cities still have a high volume of unit stock to be completed. As the new supply comes online over the coming years, it is anticipated that this could lead to further softening of both dwelling values and rents in Sydney and Melbourne. In its home value report released today, which was a couple days ago, CoreLogic has a somber outlook. It's likely the spring season will be a challenging one for the housing sector. Advertised stock levels are already 7.6% higher than the same time last year across the combined capitals, despite a 5.7% reduction in fresh stock being added to the market. The rise in inventory is simply due to a lack of absorption. With fewer buyers, homes are taking longer to sell, and clearance rates of homes sold at auction have trended into the mid to low 50% range. One of the reasons for the downturn is the fairly sudden exit of investors and speculators, which for banks are among the riskiest elements. Starting in 2014, Australia's banking sector, APRA, and the Council of Financial Regulators introduced macro-prudential policies that were designed to cut down speculation in the housing market. They initially produced no results. Speculation increased and prices jumped. But as they were tightened, including the imposition of a 30% limit per bank on interest-only mortgages and higher interest rates on mortgages for investors, they began to suddenly bite. After publicized scandals, shenanigans, and the findings by the Royal Commission investigation into the banks, lending standards have been tightened on the margins for potential homebuyers as well, some of whom are now being sidelined by the new focus on sustainable debt-to-income ratios and the crackdown on mortgage fraud, particularly in the most overpriced markets, Sydney and Melbourne. As prices are declining and rental yields are historically low, investors and speculators will be further discouraged because now the quick and easy gains have moved out of view. All this is happening even as mortgage rates remain at historic lows, but mortgage rates too are expected to tick up as funding costs for the banks have risen and will likely continue to rise. Smaller banks have already lifted mortgage rates, and now Westpac has become the first of the big four banks to increase its rate for variable rate mortgages. You know, the adjustable rate mortgages. Remember those? I told you they never went away. The other banks will follow, and according to CoreLogic, this is likely to send a chill through the housing market. The real estate is local, and the prices tend to, real estate is local, and prices tend to move slowly over many years, on the way up as well as on the way down. But the housing markets of Sydney and Melbourne, ranked globally in the top housing bubbles, have passed a clearly visible inflection point late last year when price moves changed direction and have formed well-defined U-turn. New York condo prices fell again. Historic spikes slow in Seattle and other metros. Read the most splendid housing bubbles in America. Another article he has here. So, of course, I'll link this. And that's about it. Take care.